Peter Rose, Longwood Currency Trading. Quantifying your risk in your Forex trading is what I want to discuss with you today. It's going to be a little bit different discussion about risks than you might have experienced before. So stay tuned, because I think by just this one simple concept, you could improve the results of your trading dramatically, or at least the way that you think about it. So quantifying your risk has to do with stabilizing it. How do you quantify your win? How would you stabilize your win? You always want to maximize your win. I mean, that's just stupid, evident knowledge, right? You're trying to make the most when you make money, and you try to lose the least when you lose. But you don't have any control over how much money you're going to make. What control would you have over that? Just the fact that you arbitrarily, this plant is really growing up good, isn't it? That you arbitrarily say, oh, I've got a profit target of 20 pips. What's the guarantee that you're going to get to 20 pips? Maybe this time you'll only get 3 pips. Maybe next time you get 40 pips. So you have variance in, uncontrolled variance in the win factor of your equation. You also have not only no control over the number of wins, but also the amount of the win. One time the win could be $10, one time it could be $1,000. It varies. Let's look at this risk component then, this loss component. You have two functions of that. The number of times that you lose and the amount of money that you lose when you lose. Do you have any control over the number of times that you lose? No, you don't. That's what the win-loss ratio balance is. You're a 60-40 loser, so over the long run, you'll win 6 times and lose 4 times. If you're a 70-30 win-loss, you'll win 7 times, and in the long run, you'll lose 3 times. Now, what about the amount of that? You know, like I said, when you win, you could be scared and pull your chips off the table as soon as you get $10 ahead. But in your loss, you tend to let those losses run. 20 pips, 40 pips. You know, if you lose 40 pips 3 times and you win 10 pips 7 times, you know, your things are not going to go well. So you don't have any control over the number of times that you lose until you have an averaged value. But what's the variable, the next variable? It's the amount that you lose. You can quantify that, right? Nobody talks about that. They all talk about this stupid risk to reward ratio and all this just stupid shit. Well, where's the congestion point that I could set my loss to, or whatever? Very few traders out there set a static loss point. Now, my friend Gary Langers, the scruffy trader over in the UK, he's got sort of a standard 20 pip loss. He's a day trader like I am, and he has a standard 20 pip, I'm just going to call it a day. And what he does is, if price moves against him after his entry, he'll add lots, and that reduces his risk, so that when it turns around and goes the right way, he's already made the amount of money that he originally had just by going from his losing positions to where his initial entry point would have been. Really slick if you can do that. He's not encumbered by the FIFO rules as we are in the United States, and other aspects of it that he uses in his thing, because really what he's doing is averaging down. That's really what's happening. It's a little bit different because he's not encumbered by those FIFO rules, and also because he's really, really good and has a very, very high win-to-loss ratio. And so even though he stages into his positions as the price moves against him, he takes that 20 pip value, loss value, and says, well, my position size is X amount. let's say he has 5 minis staged in all the way down from his entry point. He stages a mini in at entry, and he stages another one in at 5 pips under, and another one in at 5 pips, so that by the time he gets down to 18 pip loss, he's got 5 minis staged in, and then he hits that 20 pip loss point and he closes the position out. So the minis that were added close to the closeout point really don't count for much of the loss, so it isn't that big of a hit. So all he's doing in his head is he's adding up the value of the position and the average, so that when he takes the 20 pip loss point, he's got an idea of what that loss value will be. And it's not a static amount because he varies where he's staging in and all the rest of the stuff. So at least there's a static 20 pip loss point. My position is in working with folks that are trying to get out of the 4 and low 5-figure accounts and have the confidence to be able to trade a 6-figure account. Do you want to trade a 10 full lot position at $100 a pip and stage those 10 lots in, or 5 of them in, so that you've got an average negative position, that when you go to 20 pips, it's 20 times $50. You're $500 out just to start, regardless of what value you put on there, right? So that can be disconcerting. Again, it has to do with your win-loss ratio, whether you can make that up or not. It complicates things when you average in, when you average down. That's not quantifying your risk at the level that I'm talking at. I'm talking to those of you that are in that 4-figure to low 5-figure account size, 21 to 31 years of age, so that you've got the confidence and the energy that goes in to try to solve these problems, and you're more able to accept a loss and say, oh, okay, that's just one loss. It's not the series. It's just I lost one game, right? And you have confidence in your team that over the long run you'll win more than you'll lose. And if you have a high win value, you're 6 wins and 2 losses in the season so far, you're doing pretty good. And trading is the same way. But I guess the condition that I'm trying to focus on here when you're quantifying your risk is that the risk is not only quantified as to a pip value like Langer's has, but it's an amount value. And that is combined with a short stop point. Now, I get criticized a lot for the short stop point. If I'm trading on a 5-minute chart, that stop point is 8 to 10 pips, depending on the volatility that we're working on at that time and the spread. Look, you could go into a position where you've got a 2-pip spread and you're paying a 2-pip vig to get into that trade. So you're basically 2 pips underwater when you put the trade on. So if you've got a 5-pip stop or an 8-pip stop, you're losing 2 over 8. 1 over 4, you're losing 25% of your free runway to that stop just by entering the trade, and so you may have to go out to 10 pips. For those of you that are starting, my suggestion is you trade 1 mini and you have an 8-pip hard stop, and that's it. That's it. And you just go ahead and lose as many times as you got to lose until you figure out how to get a better entry, right? You don't know whether your entry is going to be successful, but you have to base that on probabilities. But those probabilities are affected by how much you're going to lose. And if you say, geez, my loss is not quantified, that's going to affect this. You're going to say, oh, I got to push this. You know, I lost 20 pips last time, so I got to really push this profit target now next time. You don't want to be dealing with that. When you get to the larger trading bank sizes, when you're in the six-figure range like I am, and you're trading 10 or 15 full lots or 20 full lots at a time, you're not going 15 lots in at your entry. You're staging into those positions. So now, if you don't have a quantified fixed stop, you could get into a lot of trouble. And so when you get to the point where you're going to be trading that six-figure account, and that's what I work with people in doing, not trading like your six figures, but trading to make sure that you get a good win-to-loss ratio. That's the key to the thing. And the way that you learn how to do that is by having a better entry process. And the only way that you learn how to do that is by quantifying your risk and locking it at 8 pips, regardless of what your spread and everything else is, because otherwise how are you going to learn? And so as you're starting out, you quantify that risk at 8 pips. And because you're only trading one mini lot, you don't have to worry about the size. It's 8 pips you're going to lose. It's $8 you're going to lose as a result of that. So your loss is fixed. So your responsibility at that time is only to learn how to learn entry theory and entry analysis. And a lot of what I do, all of what I do, is based around those, in teaching, is based around those two things. To keep it simple. Because when you get up and you're trading high 5 figures and 6-figure level accounts, that's when you add the complications of staging, compounding, reverse staging, all of those kinds of things that are inordinately complicated if you don't have a solid base, and that solid base has to be premised on the only thing that you have control of, and that's your risk. That's quantifying your risk. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.